Well, welcome to another edition of Econoday Unplugged. It's Tuesday, the 12th of April, 2022. Terry Sheehan's on the US East Coast, and I'm Jeremy Hawkins in London. The US yield curve has a good enough track record predicting recessions, and its recent, if short-lived inversion across some key maturities has got investors seriously worried about a possible recession. Now, in the face of quantitative easing, COVID, and of course the war in Ukraine, it may be that the old rules simply no longer apply. But if the aggressive central bank tightening currently priced in by financial markets proves accurate, avoiding a hard landing may not be possible anyway. One thing that is clear, though, is that inflation and growth continue to move in opposite directions in many countries. The dilemma facing central bank policymakers around the world is becoming all the more acute. On the output side, so far it's manufacturing that's taken the brunt of the hit, with the global PMI sector output index sliding to a 21-month low in March. But services growth has also slowed. So let's have a look at what the latest data are telling us about the economic outlook, and with a number of central bank meetings scheduled this week, what it might all mean for interest rates. Okay, then, Terry, before we get on to today's biggie, the inflation report released just a few minutes ago, how has the US real economy fared since our last podcast?
Well, the labor market is continuing to add jobs at a hefty rate. The first quarter alone was well over 500,000 a month. The unemployment rate is down. Initial jobless claims, which are usually a pretty good forecast of where the labor market is going, are at near record lows. So that side of the economy is doing fairly well, although there are some signs that wage growth has slowed and that employers are beginning to find some workers. So there's probably some expansion in the labor force there.
Yes. Okay, let me play devil's advocate, as you know I like to. Factory orders, February declined for the first time since was it April last year, with this ongoing supply constraints and shortages of raw materials and so on. Is that relevant, or do you think that's just a typical monthly blip and you can look for better numbers in March?
Well, it's certainly a headwind for the economy because, of course, with what's going on in Ukraine, it means that the supply shortages of critical parts are not going to get better anytime soon. We are seeing some upticks in COVID rates here and elsewhere. So, worries about how that's going to affect the production and the economy are very much there.
All right. And the other side, I guess, which is particularly, well, I suppose really it's relevant, particularly from the European side, because over here things are looking not quite so good, is obviously the consumer sector. I mean, Here we've seen a relatively sharp decline in consumer sentiment. I noticed you've got your consumer sentiment numbers coming out, well, I think on Thursday this week. What's the sense over there? Is the consumer confidence starting to weaken significantly as a result of Ukraine and everything else that's going on at the moment, or is it still holding up quite well?
Well, as far as the March numbers, we're going to be getting some preliminary April numbers at the end of the week. Consumers are pretty gloomy overall. They're deeply worried about inflation. They're beginning to feel the effects of higher interest rates on their ability to finance things. They're seeing a slowing in the housing market due to higher interest rates, which means that home prices aren't going to be increasing as rapidly. Which is good for buyers, but not so good for sellers. And of course, there's the highly contentious political environment in the US. So consumers actually are not feeling very confident at the moment.
Which I suppose takes me on to the inevitable question. Was a poll from Reuters that has always been lots of that out and about over the last few days, if not weeks. New Reuters poll of economists, which says that the probability of recession next year is about 40% in the States. Do you think that's a reasonable estimate, or would you put it higher than that or lower than that?
I might put it a little lower than that. The Fed's going to have its work cut out for it to engineer the soft landing. And they simply may not be able to. They've got so many things that could slow the economy or the US economy out there. So I definitely think we're seeing an elevated risk of recession.
All right, then. Let's get on to the big news then. I guess one of the things which ultimately determine just how far rates go, and indeed whether perhaps we do get recession in the States. Consumer Price Index today, new
Yes,
40-year high on inflation. How bad was it?
that's bad. Although the numbers were pretty much as expected, still the reality of them is going to be disturbing. Consumers are seeing some relief on things like gasoline prices, which is nice, but they're still quite high relative to what they've seen in the last few years. And with so many other expenses like food going up rapidly, households are seeing their discretionary income just be eaten away.
So it boils down then to, well, certainly if the markets have got it right, we're going to have what appeared to be an extremely aggressive Fed over the rest of this year. Last week, we had out the March FOMC minutes, which outlined the quantitative tightening plan, which at least superficially anyway looked to be, well, pretty well aggressive in itself. So again, I suppose to come back to the fact, do you think this risk of quantitative tightening going hand in hand with Fed tightening via interest rates, it just very much increases the risk that we could see a recession?
If they overdo it, yes. Now, remember that we saw what they're discussing, not what they're actually going to do, although in the past, these two things tend to be pretty much the same. They always make the point that, policy is not on a preset course and no decision is made before the meeting. So, and also that it's made on the best available data at the time. I do think that the Fed is anxious to get the size of the balance sheet down. So I do think we are going to see relatively aggressive reductions in the size of that, but they can always modify that later. I do think that there's a high probability that we'll see a 50 basis point rate increase at the next meeting, just because if you listen to recent remarks from the Fed policymakers, they are deeply concerned about inflation, and this morning's report for the March CPI certainly does not give them any reason not to do 50 basis points.
I was going to ask you on that because certainly, I mean, clearly something which really spooked the bond market and indeed equities last week was Lael Brainard when she came out and, someone who typically perhaps amongst the marketplace is regarded, at least on the dovish side of the overall FOMC. But she came out as really was talking, by her standards, pretty aggressively. Do you think there's a chance now, say, a 50 basis point at the next meeting and perhaps another 50 basis point after that? I was wondering if you perceive her comments as more of an acknowledgement from the Fed that they're perhaps getting dangerously behind the curve.
I think they may be feeling that way. And Lael Brainard certainly is classically typed among the dovish policymakers if we go back to the Yellen years. I think if you look at the FOMC meeting minutes, the fact that it was pretty clear that the only thing that held them back from a 50 basis point increase the last time was the invasion of Ukraine and the uncertainties raised by that. So far, at least, the US economy hasn't been seeing too many impacts. There are some disturbances in financial markets, of course, but overall, things seem to be working pretty much as they should. I think that there will still be strong sentiment for a 50 basis point increase. And if we don't get any disastrous economic data in the interim before the meeting, I think a 50 basis point increase is very likely. Now, we've got the first estimate of first quarter GDP coming out later this month, and that's looking to run somewhere between 1.5% right now. A lot's going to depend on what the retail sales data tells us on Thursday when it comes out.
Okay, let me ask you one last question on this. There's some comments coming which came from Bill Dudley, the former New York Fed president. I think it was last week, remember rightly, when effectively he was saying that the Fed needs to hurt investors if it wants to beat inflation. So essentially, asset prices need to come down if it's going to actually slow the economy enough to, to put a lid on inflation and start to see prices decelerate. Is that, do you think, sort of a typical view of what's actually the FOMC now thinks, or is he someone who's been and gone, so he's just talking his own book?
Well, I think he is talking his own book, but that doesn't mean that he isn't a well-informed person. I think that Chair Powell and the other policymakers are really going to be very careful in their public comments to try and put forward a view that causes the least possible uncertainty and disruption for anyone listening for the outlook for monetary policy. So I think Bill Dudley gets to say something perhaps a little more bluntly than Fed policymakers can right now.
Okay, excellent. Thank you for that. Anything else you'd like to put in from your side?
No, I mean, this morning we got the NFIB index on small business optimism, and small businesses don't appear to be particularly optimistic right now. But they are facing higher uncertainties, and it's more, if you look at the details of the index, it's more that they're worried about the future than things are bad right now. So I think, at least at present, the U.S. economy is doing all right. It's returning to something that looked more normal than it did even 6 months ago. But we have to be very cautious at the increased risk to the outlook.
Yeah, sure. Nicely put. Okay, great. Thanks for that, Terry. Now, before we move on to Europe, then, just pop across the border to Canada. As mentioned, there's a number of central bank meetings scheduled over the course of the next few days. Wednesday, we'll see the Bank of Canada make their announcement, and they are now pretty well unanimously expected to hike interest rates by 50 basis points, taking their key rate up to 1.0%. And indeed, it's very likely, I guess, that we're going to see a relatively strong statement coming out the Bank of Canada as well, in the wake of what's been a strong March employment report. Indeed, a good deal stronger than expected March employment report. We had a record March PMI, and of course we've got inflation, what was 5.7%. That's at a 30-year high as well. And indeed, even the Bank of Canada's own business survey they released the other day, that found a record number of firms expecting prices rising above 3% over the next couple of years. So you pull all that little lot together, and it really does suggest that Terry's talking about the Fed tightening aggressively this year, and it seems to be the case that the Bank of Canada will be very much following in its wake. Okay, in terms of Europe, on sort of my side of the pond, we do indeed also another central bank meeting here with the ECB due to make its statement on Thursday. Now, in contrast to Terry, on the whole, not doing too bad a job at talking up the US economy. Europe, well, clearly it's suffering much more from the fallout in Ukraine. And I guess that's also reflected in Econoday's ECDI, our Economic Consensus Divergence Index. That's currently running at -30. And if we look at the real components of that, it's running at -29. So put quite simply, it means that the economy as a whole is underperforming market expectations. And indeed, it has been for some little while now. So it really does make for downside risk to the way the economy is currently performing. Also, it's mentioned just in the context of this sort of thing from the COVID angle as well. COVID has started to come down pretty well right across Europe now, but in some countries like Germany and indeed in France as well, it's coming down still quite slowly and from relatively high levels as well. And that means for some countries, notably Germany, some of the expected lifting of restrictions which were planned for this month have now been shelved, and they won't be introduced until at least some point in May. And inevitably, that's just going to add to the time tightness of some of the labour markets out there and potentially put for upside pressure on wages, which in turn means, of course, additional upside pressure on inflation. So moving to Thursday then, and it really is a sort of a double-edged sword, a rock and a hard place as far as the ECB is concerned. They have to be worried about the fallout for the Eurozone real economy as a result of what's going on in Ukraine, plus all the increased global supply problems we had due to the zero COVID policy in China and parts of Asia at the moment. But of course, at the same time, inflation, at least by ECB standards anyway, is completely through the roof. Now, the minutes of the March meeting issued last week confirmed the more hawkish stance they adopted there. But in contrast to so many other central banks, it still seems as if an actual interest rate hike is several months away. Under the current forward guidance, we still need to have quantitative easing ending first. And as that currently stands, that's set to run, albeit at a diminishing rate, at least until we get into the third quarter. It will be phased out in theory as we go through the second quarter, but they still haven't put an official end date as far as the third quarter or when it might be. It looks as if they're aiming to end quantitative easing in Q3, but they've said last time that it's going to be very much data dependent, so we'll have to wait and see what happens. But nonetheless, it looks as if it's going to be a relatively slow process anyway, in terms of finally getting to that stage where we can see Eurozone interest rates actually being hiked. So don't expect too much out of Thursday, although I must say, just in terms of the ECB trying to preserve some kind of credibility, when we got inflation, now up at 7.5% in March, they will need to, bang the drum on the rhetoric with regards about the need to meet their price stability objectives. Otherwise, so the credibility really is going to struggle. Quick round off the economy. Retail sales in February, well, at least they were up, but it leaves March needing an increase of more than 2%, absent of any revisions, just to hold first quarter retail sales flat. And that's another indication of the fact that consumer confidence across most of the Eurozone has really fallen quite sharply in the course of the last month or two. Industrial production sector, we'll get an update on that on Wednesday. It'll only be for Feb data, though, so it's still really before the Ukraine effects. But it looks as if it's going to probably leave the first quarter on running at something like a 1.5% quarterly rate, something like that, unless March is particularly weak. So pull it all together. First quarter growth in Eurozone, our guess is going to be around about the 1% mark. But from the way things are shaping up at the moment, particularly if you believe these confidence indicators, and we're going to see a fairly sharp decline in growth in the second quarter. And indeed, there must be even at least an outside chance we could even see a contraction coming through as well. Other bits I should mention with regards to continental Europe, we had the French general election, or presidential election, I should say, on Sunday. To no one's big surprise, Emmanuel Macron, the current incumbent, won that ahead of Marine Le Pen, who heads up the far-right National Rally Party. However, the gap between the two was, just over 4 percentage points, and that's a good deal tighter than it was when we saw the same two having a runoff in the last elections in 2017. So there's going to be a lot of scrambling about by Macron to try and ensure that he can win the second round. We'll get that in a couple of weeks' time on the Sunday. By and large, it still looks as if Macron will be victorious, but given we're talking about politics here, and we're also talking extremely low turnout, it could well be a lot closer than people think. And again, there could be at least a small chance, or an outside chance anyway, that Le Pen could surprise and actually win it. And were she to do that, it really would have significant ramifications for the whole of the European Union. So it will be one very much to keep an eye on. Okay, what else we got then coming out of the UK? On the whole, again, a bit like Eurozone, I guess. The first quarter looks to be doing okay. February GDP, the monthly number came in with growth of just 0.1%, which was certainly weaker than expected. But that was after a 0.8% increase in January, which was well above the market consensus. We're now, 1.5% in terms of total output, being above where we were just before COVID struck. And on current trends, we're probably looking for quarterly growth in the UK, about 1% or so. So 4% at an annualized rate for the fourth quarter. Labour market data we had out this morning was another pretty solid report. True employment growth has slowed a bit, as has the decline in unemployment, but wages have picked up again. And you pull it all together, it suggests that at least first quarter momentum for the UK was strong enough, very much so, to support additional interest rate hikes out the Bank of England. And on that front, Wednesday we'll get an update on the inflation side. That's going to see, by the looks of it, another increase in inflation. The market consensus on that is 6.7% on the headline rate, up from 6.2% last time round. And of course, that's before we get into April, when the energy cap was raised by some 53%. So there's a very good chance, I suspect, we could see inflation moving up to about, 7.5% or so once we actually get into next month. Markets now looking for the Bank of England's bank rate, their benchmark rate, to be up above 2% by November of this year. So that's gone up quite a lot from previous expectations. And I guess just a general reflection of what we're seeing almost around the world at the moment, whereby speculators are seeing central banks tightening a good deal more aggressively than anticipated, even just a few weeks ago. Elsewhere of note, I should be mentioning in terms of Asia, the zero COVID policy is still causing all sorts of damage to the Chinese economy at the moment, with some shutdowns of the major ports and due to ongoing self-isolation as well. There's a range of Chinese data out this week, which could well be a precursor to fresh easing from the central bank. Indeed, there's been noises coming out of the State Council on several days over the last week or so. It really is seemingly anyway providing the fodder for market speculators believe that we are going to see some kind of ease, be it in terms of lower interest rates or another cut in banks' reserve requirements. But in contrast to most of the rest of the world at the moment, China's still very much doing its own thing, looking to loosen policy to try and support what it's starting to become something of a shaky looking economy, at least as we record this podcast anyway. And certainly some of the major banks now, the private sector banks, are revising down their forecast for Chinese growth for 2022. South Korea will get the Bank of Korea holding their central bank meeting. That's on Thursday. General consensus there is for another 25 basis point increase to 1.5%. But it's worth bearing in mind that the economy there has actually slowed a little bit since they last met. And indeed, this will be the first central bank meeting to be held without a governor, as the current nominee, Ri Chang-yong, still faces a parliamentary hearing to take up the position. So if not this week, chances are they'll do it in May, but markets looking for it to come through in this week. Also later today, the Reserve Bank of New Zealand, they're widely expected to raise interest rates again. It's already tightened by 25 basis points at their previous 3 meetings. Expectations here seem to be pretty well split between another 25 basis point hike or well, it's potentially a Fed, possibly a full 50 basis points as they try to bring inflation back under control. At their last meeting, they indicated that then when they did hike by 25 basis points, that was very nearly a 50 basis point move. And indeed, they increased their own forecast for where they think their benchmark rate's going to top out by a full 75 basis points up to 3.35%. So whether it's 25 or 50 basis points later on today, it looks as if New Zealand interest rates have still got some way to go. Okay, then, well, let us round it off there. I guess when you're looking at the data at the moment, it's quite often it's never easy identifying underlying trends. And with COVID and Ukraine crisis at times pulling in different directions, that's certainly the case at the moment. However, consumer confidence is under pressure. And the likelihood is that business sentiment will follow suit as Russian sanctions and still higher input costs take their toll. Consequently, with supply chain problems likely to worsen before they get better, stagflation is a very real prospect for an increasing number of countries, all of which should make for a very volatile backdrop to financial markets and underscores the need to keep up to date with all the key policy moves and economic statistics in Econoday's global economic calendar. On behalf of Terry and myself, thanks as ever for listening, and we look forward to seeing you again next time. Bye for now.